Well, we're seeing a turnaround in the bond market here today after what's been a remarkable meteoric rise over the past few weeks. It's been roughly a month since the Federal Reserve cut rates by 50 basis points. And I think the conventional wisdom is when the Fed cuts rates, interest rates should go down, right? Not in this case. The 10-year yield is up about 50 basis points on the nose since we had that 50 basis point rate cut on September 18th. And I think that deserves a little explanation. So allow me, or let me explain why that might be the case. There's a few things in play here. First off, if the Federal Reserve is cutting rates when the economy is running hot, odds are that they actually restoke inflation. If we look to the Atlanta Fed GDP Now growth tracker for the third quarter, all those fears of recession that were in play at the start of August look so silly at this point in time. 3.4% rate of growth adjusted for inflation as we look at the third quarter reading, and that's due next week. So when we have a rate cut in an environment where the economy is actually still going quite strong on the macro level, it increases the odds that you have reflation. Asset prices go up. Bond yields need to reflect that higher inflation, higher growth potential long term. So that gets baked into the cake. But the other side of this, I think what we're starting to look at here is the signal that's coming from within the market that we have a decisive victor in the 2024 presidential election. And that presidential election winner is one Donald J. Trump. If we look at a basket of Trump-related stocks, something like Geo for private prisons. You could go to something like Wynn for the casinos. One of his major donors is Steve. You could add a name like Rumble into there, the video platform, or DJT itself. An amalgamation of these theoretical Trump-friendly stocks has been outperforming the broader market, the S&P 500, since September 18th. So when you look at the rise in bond yields and you think about what a Trump presidency would mean, you have a trifecta Republican government, unified government, you have more government spending, you have lower taxes, you have higher asset prices perhaps. What happened in the wake of the 2016 election? Higher yields, higher equities, stronger US dollar. And that's been the story for the past month here. So bonds, they may be weaker now because the Fed has cut rates, and that could be reflationary. But there's also a bigger political issue that's going on here. And it's one of the reasons why I look at bonds and they're in the dirt and I say directionally, I would love to pick up some bonds cheap here, despite getting kicked in the face repeatedly over the past 3 weeks with long deltas. I think the better play when we look at the IVRs that are on the table right now, you're looking at ZB and ZN that are effectively tethered to their 6-month high-low midpoint ranges. And with the IVRs at these levels, instead of being directional and trying to be a hero and predict Trump win, Kamala win, Fed cuts, Fed doesn't cut in November, the iron condor probably makes the most sense here to avoid all the noise of politics and the Federal Reserve. That's where I'm adjusting my positions today. It's been brutal staying long bonds the last few weeks. I guess we had to pay back some of the gains that were given at the end of July, beginning of August. But now is the time to adjust because there's been a lot of damage here. And quite frankly, a lot of shifting factors that precipitate more sideways chop.
Okay. Because I can't argue that anything you said was unreasonable, because it's not. I don't need I guess I don't look for a reason. I thought we waited a long time on bonds, by the way, too. I thought we waited when they were 126, 127, I kept thinking I really wanted to get under 122. When I got one under 122, I loved them at 120-ish.
They went so quick to 120, it was easy to wait every day.
I didn't think they were going to get down to, basically low 118s, that's for sure. I really didn't think, but I thought that was the absolute kind of low, who knows. Mm-hmm. I think that if you had to pin a reason for it, probably they rallied up too much on the actual Fed cut, and they probably sold them off way too much on after that, because there was too many.
Buy the rumor, sell the news.
It was just, there's just too many longs, and the Trump story sounds good, but to be fair, I don't think I've ever seen a politician more unclear of how the bond market works than Trump. So I don't put much stake into that at all.
In your opinion? In
my opinion.
Well, as a counterpoint to that, Tom, how many years have we heard people on both sides of the aisle pay lip service to bringing down deficits and debts because it's going to be bad for the U.S. fiscal standing otherwise? And Trump comes along and says that none of that really matters. We can spend whatever we want. And the market doesn't punish U.S. treasuries.
Yeah, the reality is that you pretty much can spend whatever you want. I mean, the only reason I think people still talk about bringing the deficit down and everything is because that's part of the playbook. That's like Playbook 101, but I don't really think anybody
accuse the other side of spending too much money.
Yeah. But I don't know how much that comes into play with what's actually happening in the bond market is my point. I think it's a good trade. And I think that when you look around, like as a trader, when you look around, all you're ever really looking for is where do you get the most bang for the least amount of risk? Like that's all it is. That's ultimately what everything comes down to. We were sitting here for months thinking that China was crazy cheap, not because we really cared about China at all, just because we felt like, okay.
Cheap relative to the rest of the market.
Cheap relative to the rest of the market. It's cheap relative to U.S. tech stocks. I look right now at the bond market and I don't really care about bonds that much. I mean, none of us do. We don't even, we trade bond futures and some options, but we don't really, buy bonds in the traditional sense.
The coupon.
Physical bonds, coupon bonds. So it's not something that we really care about. And yet I find it, fascinating because of where they're trading relative to everything else. I think that's cool. And so when you look at all the different marketplaces right now, you look for the deepest, most liquid markets and bonds are there. They're among, top 2 or 3 markets in the world, and they feel like they're cheap relative. That's all. I think that's a good story. So I don't care what, what gets you. I don't love the iron condor part to it because unless it's skewed, because I think they're on the low end of the range. So I don't really want a 50-50 shot type of thing or a 60-40 shot. I'd rather have something where you just get a bigger payout, a little bit, maybe that asymmetrical risk return, that kind of thing. But other than that, what I do find interesting is that the stock market has gone to new highs while the bond market is essentially, I don't want to say it's crashed, but a 5 or 7%, actually, let's see, it's almost 9 points. So that would be almost a 7% drop in the bond market is pretty significant with the stock market going to new highs. Yeah. And I think that is the thing that's most concerning. What?
I'm with you. And this is a kind of a, we want to bring in a long-term valuation argument for why maybe returns for stocks could be a little heavier, more difficult to come by over the next, say, 12 months, forgetting the seasonals and whatnot that we have in the short term for election years. The earnings yield right now on the S&P 500 is, as of the end of last quarter, is 3.59%. We have to see what the earnings now bring in for the rest of this third quarter, and there's still 80% of companies to report. But let's just say it's 3.6% between friends. The yield on the U.S. Treasury 10-year right now is 4.176%. So one of the concepts that fund managers use is called the Fed ratio. If the earnings yield on the S&P 500 is less than the nominal yield on the 10-year Treasury, you'd have no reason to buy stocks. You can get a better risk-adjusted return in bonds. So at these levels, right, there are probably some capital allocation decisions being made. Why do I want to buy the S&P at all-time highs or the NASDAQ, which has PE ratios that are in the high 20s here, historically at the high end, starting to get into dot-com bubble territory, though not there yet? Why not just go into long-end treasuries, which I can clip a 4% coupon now and not need to worry about any of that stuff because, hey, this is risk-free returns. This is a serious headwind for equities at these levels. When the yields on bonds were below the earnings yield in the S&P, you can make the case that investing in stocks long-term is still the better bet. Here, this could be a headwind.
Yeah, it's definitely at 118, the whole game changes. In the 118 handle, the whole game changes. And I agree with that. I think that you're not lowering rates at 118 when the bonds are in 118. That's for sure. So anyway, we'll see. On the stock front's getting to be very interesting going into the election too, because with stocks, if they stay up here, with stocks wrapped around all-time highs,
right?
Yeah, it presents a really interesting picture. Because you're, just like you said, you're in, I don't care who wins the election, you're in dangerous territory with respect to just, you're sitting in an area where there could be a lot more velocity to the downside than the upside. That's all. I don't think we're crashing or anything like that. I just think there's a lot more risk to the downside on a short-term basis than there is to the upside at these current levels. We might have a sell-off prior to the election, which normalizes all the risk, but we haven't seen that yet. I'm not sure what you think about that.
Well, this is day two of a decline where this is actually the first back-to-back declines potentially in the S&P 500 in 6 weeks. It's been a really strong run since the beginning of September, and perhaps that would be a warning sign that maybe this upward thrust is ready for a breather, right? Changing character of how the rally has proceeded for.
Yeah, but yesterday the NASDAQ was up 50 handles yesterday, and the S&Ps were down 4 at the end of the day. I know during the day they were down 35, but at the end of the day they were down 4 or 5 handles, and the NASDAQ was up 50. So it's hard. It would be difficult for me to call yesterday a down day.
Oh, listen, I'm not abandoning my bullish pretenses here. We're just looking for clues to maybe something's changing. And the fact that it could be day two in a row of an event that hasn't occurred in 6 weeks raises an eyebrow. Nevertheless, though, I think the conversation here that's more interesting than what stocks are doing right now is what on earth's going on with gold and silver. Silver has exploded here the last 3 sessions to the upside. And I think for many people, it's been a confounding environment because you have a stronger dollar and higher yields. Look, there's a bigger picture story going on here that relates to the Russian war in Ukraine. It's something that we've talked about on Futures Power Hour and Overtime for several months now. But when the West put these sanctions on Russia against their FX reserves, you got to think your FX reserves as a country, that's your last line of defense. That is the coins under the cushion that you raid in the worst case scenario. So now a lot of central banks are looking around and saying, well, hold on a second. We can't raid our own piggy bank if we fall out of line with the West. What are our other options here? And there's been an accumulation of hard assets among central banks globally now, particularly out of China, where we've seen the buying resume in recent weeks and months. This is a very difficult market for me to even think about fading. I've, of course, been a ridiculous structural bull on precious metals for the last several months. And so this upside swing is personally very beneficial. But for the people out there that are looking at this through the typical tasty lens, as I often say, selling calls in gold and silver for retail traders, it exposes you to the potential double tap of not only price moving against you, but expanding volatility, undercutting your position further. So this is not a fade type of market. Gold and silver have weathered what was a considerable storm with those yields moving up, and they're still trading to the upside. Gold and silver are not worth fading here. I'm a buyer on dips all the way to 3,000 in gold and all the way to $43 in silver, as I've been crazy enough to say for the past 6 months.
I think you have to stay short premium in both. It has not worked out yet, but I'm definitely not a buyer, but I'm also not selling them. I mean, I'm staying delta neutral, but and just
to his point, volatility has expanded. And
well, volatility will expand to the upside, especially.
Right. Yep.
Yeah, I mean, no question about it. Yeah. Yeah, I think you covered that good. I mean, listen, I'm surprised by the strength of the move, especially in silver, obviously, but both gold and silver. I'm not fading it. I agree with you.
Well, I have a question for you guys then. I haven't really taken part in the China move directly. I had no exposure to Chinese equities during the move. I had some copper on, of course, but that's no longer really in play, at least the trade that was structured for the China move. How are you guys looking at FXI, A-shares, Baba, Baidu moving forward after what's been a very tumultuous month? We've given back about half the gains after the September rally.
I mean, we're staying long all of those. So I'm long Baba, Baidu, FXI. I mean, we didn't buy anything at the top. We just didn't get out. So I mean,
but these stocks have lost 20%.
Yeah, but they made 30%. They made 35%. It was crazy. We were long at the bottom. We legged out of, we took some profits all the way up. We didn't take them all off, and now we're kind of still in them.
Way down again.
But net, it's been a very profitable trade. So I'm just staying long them all. I think you have to stay long them all. I think this is a pretty normal pullback, and to be fair, I'd rather be long Baba and Baidu here and FXI than short it.
Fair enough.
Yeah. I think those are. I like extremes, and I feel like this 20% sell-off, is an extreme. I'm the same reason I'm short the dollar and long all these other, currencies. It's just simply because they're at an extreme, not because I really care about anything else
or even understand it. Good job out of you, my friend. You did it very well. Presented your case nicely. We'll take a quick 90.
I don't think so.
Take a quick 90-second break and come back. We got more Tasty Live after this with a market measure. Back in 90 seconds.